Okay, guys, big day today. Big day. I spent about 2 hours probably last night prepping, actually, maybe 3 hours getting all this stuff ready, just thinking through it, mental modeling it. So, we have an accounting system I'm building. It allows you to enter transaction log and produces financial statements. We are talking about um, US GAAP compliant. We've got accruals, or if you want, it doesn't have to be GAAP compliant. You could do cash basis. Uh, let's just jump in here. So the first thing is we're gonna do is the hardest, and that is taxes. So I need to actually, well, and actually before I even get into that, forgot. Let me get the video out here, and don't forget to check out more financial models at smarthelping.com. Once this template is done, I will post it to the accounting bundle, and I actually don't know how much I'm going to charge for this system. We'll see, but it will be less than 225. And you can check out all financial models here, 9.99 lifetime access to anything I ever build. Okay, so let's post our stuff to Twitter and get going here. Post our Okay, awesome. Get the analytics up here. So, uh, hardest thing first, taxes, deferred tax liability or asset, and then we'll get into bad debt expense, allowance for doubtful accounts. After that, sales tax payable, which that'll be easy one, and then we'll see where we are after that. Uh, so I've been working on this all week last week. We're gonna work on it today for like 3 hours, and hopefully I can get it close to being finished. So I have to reverse out all of the tax stuff we already did. So let me find this. We're going to have to redo all the tax stuff. So where is this? Okay, so here we got to redo this one. Just mark it in yellow. Income tax, income tax. So this worked for just like applying income tax and then um, doing a payable and then a payment of that. But it's not. We have to do a little bit more granular to get all of this stuff working. So we're gonna redo these. Anything else? Balance sheet. Here we go. Income tax payable. Yellow that out. That's fine. And then we have taxes here. Okay, I think that hit all of the tax items. Let's go to the validation here where we're defining all the types of accounts. So this and this, I believe, was the only thing. All right, so we're going to need a couple more spaces here. Oh, not that many. All right, so we have to add separate entries. So income tax expense is now not going to automatically create a liability. And so what the deferred tax asset and liability just means is your GAAP um, calculated tax is different than the IRS's version of what you owe. And it will eventually even out, but let's say for depreciation, one lets you depreciate bonus depreciation, but GAAP does not. And in that case, over the whole term, you'll pay the same depreciation, but and the same tax amount, but in different periods you'll pay different amounts. So this kind of tracks the difference of those two over time. It's very, very complicated, especially if you have to do these calculations to keep track of. Oh, oh, bless me. Especially if you got to keep track of the different things that are. And there's no fill account either, so you have to actually know what the difference is and when it happens in each period. Okay, so we have income tax expense. We're going to have income tax payable, and these two can be possibly different. Then we're going to have an entry for deferred tax asset and deferred tax liability. And deferred tax asset is going to be if you end up, um, if the gap statement is saying that you are owing more than what uh, what the IRS is telling you, I believe, or less. So in theory, you're paying more now to IRS, but the gap statement is saying that you don't owe that much. So it becomes an asset, and then as you pay it, it reduces. It's kind of like a prepaid expense a little bit. Uh, let's see here. This is not easy. Um, income tax expense, income tax payable, deferred tax liability, and then the main entry here, the first entry to record it. So yeah, if I book a tax expense at 10.5, but IRS is saying we only owe 4.2, there's now a liability because we're gonna have to owe the difference, this 6,300 difference. We are going to owe later. Oh, it's so complicated. So I have to figure out how to code this into here, and what I think I'll do, I believe this is enough. Income tax, these 4 items, I think are enough. And on the balance sheet, we'll have to add some items. Uh, I don't even know. I'm just going to put it under, I'm not even going to put it in long or short term. I'm just going to call it deferred tax asset. And then here, I'm just going to put it in the middle of this, deferred tax liability. Okay, we could indent. So they're going to be their own rows. So they'll still add to total assets, total liabilities, but it's going to be a little bit different. Um, income taxes payable, I believe, stays in short term. Yeah, it does now because it's less than 1 year. So income tax payable is fine in short term, so that this account can stay there. Uh, cash flow. So the cash flow is actually where we hit all the cash sides of all the accounts. And we're going to have to basically, because this is running off of net income at the top, so we got to reverse out the non-cash items hitting net income. So let's just try and start doing an entry here. So let's say January 2023, we figure out we have a tax expense, and let's say we think we're going to owe, and this could be at the end of the year or whatever, whenever you're going to enter, or at the end of the quarter or whatever. You say, I have tax expense of 18,000. Really, it'd be, I guess the period's kind of arbitrary. Let's just say there's a tax expense there. We have an income statement item that we got to hit. So taxes here. We're going to sum up anything that says income tax expense. So that can stay as an expense. Hits the balance sheet, reduces cash. However, we have to do the adjusting entries because it's not going to reduce cash. So that's the first part of it, income tax expense. The next side of it we want to do is income tax payable. And this is the new entry I had because before I was just automatically saying whatever is the income tax expense is automatically goes to payables, and then when you pay it, this goes down. However, with the whole issue with GAAP tax calculation being different than what the IRS says, um, you got to account for these accrued differences. So let's say the IRS says we only owe 5,000 here when we figure out what they're saying we owe. So now I created an expense, I created a payable, a liability, and then the fun part, the deferred tax liability or asset. And it's an asset if, so it's a liability if you owe less here but more in the future. And you're actually going to have to calculate the difference between the total periods. Like if the thing that's causing the difference lasts for 30 years, you're going to have to calculate the total difference over 30 years and put that difference in here. And it's either a liability or an asset depending on if the IRS is having you pay more in the future or less in the future. If they're having you pay less in the future, this is an asset. In this case, we're saying we owe 18,000 in this period, but really we're only going to pay out 5,000 in cash to the IRS for this. Let's say this is just for this year. And then I'll show you what happens next year. Actually, let's say just extend these out a couple years so I can show year over year. Whenever I'm done with this, it'll go out for 20 years, but right now I just need to show a couple periods here. Okay, so we have this liability difference, and this is for, let's just say this is for the whole year. So maybe we record it in December. And we say there's $18,000 in income tax expense. IRS is only going to say we owe 5. The difference is the deferred tax liability. So now look at, we go, what's the difference there? 13,000. Now, what happens, let's say, in the next year, in 2024? Now, this is where things get real crazy. So next year, where's the next entry? Now, let's say we have an income tax expense of 18,000. Now let's say the income tax payable is higher. Let's say it's 19,000. Well, now I am going to, here I was debiting deferred tax liability, or I'm now debiting deferred tax liability, which is going to decrease it. Over here, and here's a nice thing to show, like here's what happens. The book tax is this, but the IRS is saying do. And this is for when the IRS lets you take bonus depreciation, but you can't on your GAAP. So there's a difference that happens overall. It ends up evening out. So we're trying to just reconcile this each period. So if we go over here, before we were crediting this, now we're going to start chipping away at it as the difference happens. So overall, we have a $5,000 or a $13,000 difference. We're recognizing $1,000 of that here. in the next year. So we have income tax 18, income tax payable of 19,000. So deferred tax liability is now going to get a negative. Let's say negative 1,000. And this will let us balance on the balance sheet. And overall, what should happen is every time you make these entries, when you're done doing all for this specific situation, and again, there's going to be lots of different probably situations that cause these differences, and to track them, it's very difficult. But at least I'm going to build a logic so you can put in the journal entries that show it on the financial statements correctly for GAAP. So yeah, it's just crazy. So yeah, I mean, so you have this initial amount, then let's say every year for the next 30 years you have this entry, and it could be different. Again, like every year you're going to have different different revenues, expenses. So, tracking this can be insane, um, but it's possible. So here we have this entry. Next year we do this and so on. And it could be a long-term, never-ending account. The deferred tax liability might never zero out if you have just different things happening each period. But the point is, as you get rid of this difference in each year, that it goes down. You could have other stuff raising it. It's going to depend on how each year goes. Now for the deferred tax asset, that's a different situation. So let's do that over here. So let's say we have income tax expense. Let's say our income tax payable is actually higher now. Let's say it's 25,000, but our income tax expense is only 18, difference of 7,000. And let me look back here one more time. So we're going to have an asset when these are different, when the income tax expense is less than the income tax payable for the period. So this deferred tax liability and asset account is just going to go up and down based on these differences each period, and then as they come to fruition, they kind of unwind. Okay, so let's try to do this. Where was I? So we change this. So this is 23, 4, 5. How far did we go out here? We have up to 2030. All right, so 5, and then let's do 6, 7, and 8. All right. So for 6, we have income tax estimate 18, income tax payable of 25. So now we have a deferred tax asset of 13, because in theory, as far as GAAP's point of view, we've now prepaid on these expenses a bit. And then let's say the next year they're now different. So my income tax is 18, and now let's say next year I owe a little bit less, maybe 15,000 to the IRS. So now this negative 3,000 will use up that prepaid asset. And let's say again in the next year, it uses it up again. So I had 18,000, my income tax payable is 15, so I'm using that initial difference up. Okay, now let's do some stuff here. So on the income statement, let's make sure we got all these things happening right first. So there's our recognized taxes And no, we're just, accounting, matching principal, all that stuff is in play here. Accruals. So we have this tax expense happening here, 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 and now we need to actually make it make sense. So that tax amount, what's going on the balance sheet? Well, so deferred tax asset is going to equal, oh, we haven't even done the payment yet. Shoot. So let's see. Let me go each year. So let's say also each year we have a payment that's actually made. So this is going to say, where is it? Payment. Oh wait, did I not add it? No, I didn't. So then we also have to say payment of income tax. So when you actually send it out and it hits the bank, because that hasn't even happened yet. So what happens then? Well, let's look at each year. Hold on, let me make sure I didn't miss this here. 888, 888. Okay. So now we have payments. All right, I'm actually paying the income tax, so this should just be what your liability was each period. So 13,000, 19, 19, and then in this one it was higher, 25,000, and then it was lower, 15. Oops, I forgot 2023. Wait, 3, 4, 5, 6, 7, 8. So we have 13, 19, 19, 25. 1, 2, 3, 1, 2, 3, 1, 2, 3. Now it's a new one. 1, 2, 3, 1, 2, 3. 1, 2, 3. 25, 15, 15. Okay, that's it. So 13, 19, 19, 25, 15, 15. These are the actual payments hitting cash flow. So these will reduce the liability. So let's jump in here. So I'm looking at deferred tax asset. This is going to be equal to anything labeled deferred tax asset. And then when you do to reduce it, you just do a negative. Now I'm wondering, sometimes you might have a zero balance in asset, you might have a zero balance in the liability, but I don't think I can put all these into one kind of account that either is positive or negative. I think I have to keep it separate. So we just have this happening, deferred tax asset. Let's add the previous period. Let's see what we look like here. So remember, we didn't have tax assets till 2026. Let's extend this out to 2028. Alrighty. And cash flow, let's make sure this is going out far enough. All right. So if we see this deferred tax liability or asset starts in 2026, and we need to add it to total assets. It's not a contra asset, it's an actual asset. You can see it went from 13 to 10 when it was reduced. Now, we have also, so there's that. There's also the income tax payable. Now this one's, I think we can actually keep this, hold on, let's see here. This is income tax expense, and then you're reducing payment of income tax. Okay, I think that can stay like it is then, so that's good. So here we have that payable, then when it's paid there, it's going down and down. Now it's negative here, but we'll see what we have. Okay, so that's fine. Let's do our deferred tax liability. Now that one is simply going to be, oh, is the sum of this. And it'll be positive or negative, affecting it going up or down as a essentially debit or credit. So here, deferred tax liability, we want to sum up anything that says that. Now, if you ask me, I honestly don't know. This is really complicated, but I don't know how else you're going to figure it out because the IRS has different rules for what your income tax should be compared to GAAP. Okay, so there's that going up and down, and then we could sum that up in here. Now cash flow, now here's where we essentially need to reverse out anything that's happening on this tax expense. So we were doing that here. I believe we can still do that. Add back income taxes accrued. So let's keep that there. Now reduce payments of income tax. I believe we can keep that as well. Now the question is, what do we do with these? I think the liability accounts might be able to just sit there. So here we did 18. We actually only paid 13. And honestly, this is probably going to be paid in the following year. All these probably offset. My goal is just to make sure that this logic all works so the accountant can manipulate this as needed. Okay, so now let's look here. So we accrued the actual tax expense, we added it back as accrual, and then we reduce it when it is paid. which here we're paying the first payment of 13. These are just accruals. This is the actual payment happening. Payment happening, accruals, okay. Cool. Now we're paying a little bit more. Let's now go and see where we're off on the balance sheet, because I'm sure we are. Yeah. So on the very first one, we have income tax payable goes up by 18. So we owe this. We have a deferred tax liability of 13,000. So we're just looking at these entries right here. We have income tax payable of 5. All right, where's my income tax payable? Here. This says 18. Ah, okay, so I didn't update this one. So this just needs to be income tax payable less income tax expense plus the previous period. Okay, let's try this. Nice, we match at least. So we have the payable going up. This is what we think we're going to owe the IRS. Total current liability is 5,000. We also have this deferred tax liability because we're going to have to pay the IRS more in the future. $13,000 more, which is this. Then in the next year, so 2025, now we actually have cash going out to pay that liability. And did we do this? So that, does this even make sense? The 13,000 is, no, this should be 5,000. Because we had the liability here. Let's say we paid it the next year. So 5,000 payment. Here we're decreasing the deferred tax liability by 1,000, which is the difference here on these. So now we actually are going to owe the IRS a little bit more than what we thought. We owed them less here. The difference is this accumulated amount, which will eventually zero out the deferred tax liabilities, and it could be 30 years. I mean, because these things are like depreciation effects and all. I mean, it could be forever. And new things happen all the time too that would affect these accounts. Well, let's just look through. So, and Excel's really messing with me today. Okay, so 5,000. We've paid this. The income tax payable has gone down, but it's also gone up because in 2024 we have $19,000 of payables. So we paid off the 5, but then we added 19. We have deferred tax liability going down from 13 to 12. Retained earnings is just the accrued expenses, so here it's 18 and 18. So that makes sense. And okay, let's go to the cash flow statement. So we're actually paying out 19,000. Oh wait, let's go back over. We paid out nothing here. We just accrued some taxes. Then in the next year, we actually paid some of the taxes. These accruals just zero out. This is the actual amount paid. Then in here, okay, we paid the bigger amount. These zero out again. And I think, wow, I think that does it. So you can see here, it's just this is happening over time. And it looks like oh wait, oh, so what happened here in 2026? So 2026, our deferred tax. Okay, so now we're going with the deferred tax asset side of things. So here we are accruing an income tax expense. The payable is higher. Deferred tax asset is the difference of these two. Now, I guess the question is, does this need to make sense with what's already happened up here? Or can it be on its own logic? Income tax payables going up. Let's think about this. So if we're good on this, this seems to make sense. Let's remove all of the deferred tax liability stuff now and just look at deferred tax asset. And then these would be those payments. Because if they work separately, they'll work together. Okay, good. We're still out, so that's actually a good sign. So let's see why we're out here. So deferred tax asset. This is essentially prepaid expenses here. Or the cumulative difference of what that's going to be. Um, then there's that, and then the difference is retained earnings. So where are we out here is the question. So no cash is done anything here. Now we've paid something. So we reduce the liability in 2027. Okay, so that goes down, but it also goes up by whatever was added. Cash is going down, but we're out by 6,000. So I'm missing some side of the journal entry on this one. Shoot. You really get lost in the mud quick on this. It's very easy to get lost. So let's look. So this was just deferred tax liabilities. Let me look at journal entries for deferred tax asset. This will be the hardest thing I'm doing today. The bad debt expense and allowance for doubtful accounts will be easy. Sales tax payable is going to be easy, and then the rest of it's just formatting, adding quarterly and annual statements. So but this is the hardest thing I'm going to be doing today. Deferred tax asset journal entry. Okay. Yep, usually depreciation is what causes these issues. All right. Tax expense book, deferred tax liability. Wait, where's that? Deferred tax asset. Here we go. Oh, wait. What are they doing here? Are they saying that the deferred tax account is just one account? Uh, Actuals, you have to depreciate the whole asset in year one. So in the second year, actual tax paid is 15. As we can see in year two, actual tax paid is more than the tax payable. Hold on. Okay. Yeah, so they're just keeping this as one account. Deferred taxes. It could be an asset or a liability. Let's see where to put deferred taxes on balance sheet. I guess okay, so under liabilities, and it might have a negative balance, I guess. almost like a contra liability. Like right here, it'd be a contra liability. I believe. Can I see this on the income statement somewhere? Deferred taxes. Deferred tax liability. Okay. So this is the income tax expense hitting, but then there's these deferred taxes. Let's look at something else. Net deferred tax assets liabilities. Okay. Holy crap. Look at all this stuff. Oh wait, oh, this is other stuff. This is not just for taxes. Okay. Uh, um, Jeez. What are we trying to say here? All this stuff goes into deferred tax assets, liabilities account? All right. All right. We're going to make this simple. Okay. Let's get back into here. Here's what we're going to do. So this account is just going to sit in liabilities, first of all. We're not even going to put this deferred tax assets, not a thing. We're going to call this deferred taxes liability asset, deferred tax assets liability. Actually, it'd be a negative if it's an asset in the liabilities section. So what I want to say here is this is just going to be the aggregate effect of all of this happening. So deferred tax asset, deferred tax liability. And it's just going to be debit or credit. Because if I look here, oh my goodness. Deferred income tax assets. Oh wait, is this is sitting under assets here. Let's see. Has purchase. This is insane. This is literally insane. I need we're Can I see a balance sheet? Okay, let's look at tax expense. So this is the easy part. Tax expense, tax payable. You just accrue the expense, and then when you pay, it's here. But there's all kinds of issues if your tax pays payable is different than the tax expense from period to period, but say in the same in the long term. Okay, deferred tax assets. Is this on a financial statements, tax return? I need to see a balance sheet. See, income tax payable, tax report, IRS. That's right. The payable, deferred. Where is this though? Is this in the balance sheet? Trying to figure that out. Okay, here finally. So balance sheet, deferred taxes is sitting in liabilities. And then if it's it could be a negative liability if it's taxes you've actually paid ahead. Let's look at this one. Now uh, here they've got deferred tax asset and liability as two separate accounts. Dang it. Okay, undo. We got to restart the whole thing. We got to restart the whole thing. Shoot. So we do need assets and deferred tax asset and deferred tax liability. Um, I wish I had something like this for the deferred tax asset. Because I get how this is working. We have the liability side of it. So here, if we undo, if we redo this, and then let's just remove all of this stuff and just look at this. So we have a simple income tax expense, income taxes payable. Here's the deferred liability, which is just the difference between these two. So this is what happened during 2023. Now the next year, let's say we still have everything's the same, except for now we owe the IRS 19,000. So now we're reducing this. The question is, if this is positive or negative, like if we owe or if it's an asset, what's the easiest way to automate that into the financial statements with these entries is the question. Because this makes sense as it sits now. Okay, so we have payable here, we have a deferred payable. Then you fast forward into the future, you have more, and let's say, you know, in 2024, we go and pay that. We pay the income tax of 5,000 that we owed to the IRS here. So this 5,000 gets paid, but then we add another what? We add more liabilities. We had 18,000 more. We paid 5. Deferred tax liability went from 13 down to 12. This went up by 14. Cash flow, like this makes sense to me. This is not too difficult. The deferred tax liability and the actual payments happening here, this is fine. Whatever, this makes sense. The question is, how do we go between a deferred tax liability and asset? Because it seems like it's kind of a fluid thing. Like you go back and forth depending on what happens for the period. I think the only way is deferred tax liability has to be potentially a negative account. On the either has to be a negative, possibly a negative balance on the liability side, or if it's an asset, then it could be a negative if it's turning into a liability instead of an asset. So let's assume that makes sense. And to make this really simple, let's just look at one entry. All right. So in 2024, we're increasing the payable. We're also having a deferred payable. We're zeroing out the tax expense that's actually recognized, which is the total of these two. Hey, Sharma. Okay. And then this lasts forever unless we adjust the entries somehow. So now let's say we pay these taxes of 5,000 in 2024. And let's say we pay it in April. So here we've got 5,000 in liabilities until we pay it off here. It's paid off with cash. So the payable goes away. Now the deferred tax liability is still there. So the deferred tax liability doesn't change until the next calculation of taxes. So let's say now in 2024, we have some different things. Let's say the income tax expense is now different. Let's say it was 15,000. And let's say the income tax payable was 16,000. Well, now deferred tax liability is going up, or the we actually will have an asset here because now we're going to pay more than what we have on our books. However, in the previous period, we paid less. And so this deferred tax liability is trying to predict what's going to happen with this situation, but now there's other things that have happened. And that's what we have to figure out how to reconcile. So let's say this is now negative 1,000 in the deferred tax liability. Now let's see if this makes sense. So there's the actual tax accrued hitting the income statement. 2024. Okay, now what's happening in 2024 at the end? We have payables rising high. We have deferred tax liability going down 1. Because the net effect was, well, instead of reducing, well, technically, so instead of reducing this, we actually increased it. Or we actually paid more, so we reduced the liability by net of 1,000. Now this balances. Nothing happened with cash. We now have an income tax payable that's really high, and that's got to unwind over time. Retained earnings is just the total amount of taxes. Cash flow, what's happened is we've just paid only this 5,000. This is what paid on that. We have that, and then you'll have to go in here and put, now let's say we pay 2024. Let's drag this down. So now we say payment of tax here, and we pay 16,000 in 20, and let's say this is paid in April of 2025. Okay, so hold on 1 second. Okay, so if we look at the balance sheet now, what's going to happen when we pay that amount in 2025? Our payable goes down, which is right, so we don't owe the IRS any more money. Our deferred tax liability does not change. It's just saying we have a net of 12,000 that we're still going to owe from that first year that hasn't been unwound yet. And I think we have it. I think that's it. And all we say is potentially this deferred tax liability could be a negative number over time. Like let's say let's do this again for 2025 to 6. Let's say we had income tax expense of 2,000, but we had income taxes payable of 25,000. So now that's a negative 23,000. That will reduce that by, and then we pay the previous period, then we pay the actual amount owed of 25,000 here. So if we look at that, now look what happens. We should see a negative balance. Yep, and there it is. So now in 2024, when this happens, we're saying, look, we now are paying way more than what GAAP's saying we should pay. So we're actually having a prepaid expense, which is an asset. And look at this. We've now decreased the liability so much that it's now an asset. And now over time, whatever happens from that, it'll go up and down based on whatever happens. We have income tax payable here of 41,000. Now that goes to zero when we pay it off in April. When we pay off 25,000 in income tax here. Now wait, what happened? How did we go? April 2025, we go to zero. How are we getting down from 41? April 2025. Oh, so we have this payment here happening in 2025 as well. So 23, 24, 25, and let's say this is 26 so we're not confused on what's going on. And then this is 2027. So I can walk you through it now. So we had 16,000. We paid that off. We still have a positive liability. Then we go forward here, and now here's where we have the big liability coming in from the IRS. But we're saying it's different. We don't owe that much. So The net difference hits deferred tax liability parentheses asset. So negative means it's technically an asset or it's reducing the liability. And then when this gets paid here, we pay this 25,000 April 2027, so the income tax payable goes down with cash happening up here. Oh, I'm excited. This is actually working. So this will work great. I'm so happy. It's not super detailed, but at least you have the logic to account for deferred taxes. And a negative in a liability is essentially an asset, or if it's a positive, it's a liability that you're going to owe. Now, if this ever unwinds, what that means is you finally have caught up, and it might never unwind. And that's the thing. It might never unwind because you have so many different things happening. And that's fine. It's just you got to make sure you're keeping track of what's your payable to the IRS, what did you actually pay to the IRS, what's your income tax expense that you actually recorded in your income statement, and the cumulative difference is just going to be this deferred tax account. And then we balance out here. So we're good. Okay, well, that's done. Um, let's go now to, see, these can be grayed, put in gray. I don't know how, let's just keep going. Okay, so there's that. Next is allowance for doubtful accounts. So what we have, a couple entries here that we're going to have to make. So you can do bad debt expense. And so GAAP requires you to record bad debt expense in the period that the revenue happened that created it. And it's obviously only going to be if you have sales on account. So let's do an example entry of that. So let's say January 2023, we have sales on account for 50,000. And then no, if you don't have stuff on account in your cash basis, you just use the sales account, um, which is fine. But this, so we're saying $50,000 sales on account, and let's say also we don't think we're going to collect 5% of that, which is a lot, but let's just say it just so we can do the easy math. So it'd be $2,500. So what we do is bad debt expense of $2,500, and then here's where we get real funky. We have this other account that's going to be called allowance for doubtful accounts. And this is a contra asset. Now, what we're doing is essentially saying, okay, as we sell stuff in each period on account, we think some amount of that won't be collected, so it's going to be written off in as far as the tax effect goes. It will be expensed in that period, and then that expense accrues to an allowance for doubtful accounts. And I'm going to show you how we can go through and add that. I can also show you how we collect on a doubtful account, how we write off a doubtful account, with all this stuff. Okay, so sales on account, we have some bad debt expense. Let's code that in. So bad debt expense is just going to be on the, let's see, do we want to put it as a contra revenue? It's going to reduce EBITDA, but it actually doesn't hit cash. Let me look real quick. So here, let's just look at bad debt expense on income statement. I just want to see where it's normally put, just so I can have a reference. Bad debt reserve. It's just part of an OPEX. Okay. We'll just, and that's what I thought. Okay, so let's just put this here I'm just going to go bad debt expense right up top. And this is operating activity, and we just want to sum up anything that says bad debt expense. Now, nothing's actually happened to the cash yet. So all we're saying here is we want to reduce this from income according to GAAP rules. But we're going to have to add that back here. Because it's not a cash item. Add back bad debt expense. As a positive because that's going to hit, yeah, you see how net income's here. We reduce sales on account, but we increase the bad debt expense, which is the difference. So we're balanced there. We're balanced. Oh, we're not balanced here because we haven't done this yet. All right, so we have, let's think about this. How do I want to do allowance for doubtful accounts? Let me see here. So bad debt expense only happens once here, and it always affects allowance for doubtful accounts. Allowance for doubtful accounts. Now this is when it's written off, so this will be a separate entry. And then when you recover it, it's another separate entry. So we're going to have to do some a couple different things here. Now, technically, I'm trying to think if we actually have to name this account or not. So this creates it there. If you write it off, that has to affect it. Okay, so we have write off. Is there a print or a, how do you spell that? We'll just do it 2 words. Okay, so writing off doubtful accounts. Now when that happens, we say, well, so this is creating, so the bad debt expense always feeds into the allowance. So we have it here as a contra asset to account receivable. We'll just put it right below there, and we'll call this allowance for doubtful accounts. And we simply say that's going to equal go up with bad debt expense. And then we'll have more stuff here, but let's just put it here for now. This is a contra asset, so it's going to be a negative value. Okay, and yep, now we're balanced. So we have this allowance for doubtful accounts that says of this 50,000, we don't know how much we might or might not collect from it, but this just kind of sits here as a bucket. Now, if you actually collect, so no, the revenue is never changed. You just have this bad debt expense that feeds into this kind of slush fund here. Now, what happens when you write, let's say in July, um, you, and this can go, let's do actually a couple months of this. So let's do, here's February. I just want to try to explain it like, let's do like up to 4 months. So we do this every month. It doesn't matter what actually happens. We're just saying, look, we made these sales on account and we think this is the bad debt expense we're going to have. So it's a reserve account. What happened in March? Did we not have March? 1, 2, 3. Wait. Two, three, three. Okay. So we're making these sales. We have bad debt expense happening. It just goes into a fund called allowance for doubtful accounts. You can see this is going up over time. Now let's say you actually have somebody that says, hey, I can't pay. So what you have to do to get, so if you're writing off a bad debt, you've already expensed it. GAAP allows you to already estimate what you think that expense is going to be. So that's already affected taxes and everything else. When you write it off in this case, you're not writing off, you've already got this expense fund going over time. So you're not like writing off to take any tax benefits. It's just to adjust this fund. And so what we say now is writing off doubtful accounts. Let's say in May or June, somebody that we sold on account is just not paying and they said, you know what, we're bankrupt, we're not going to pay. So write off doubtful accounts. Let's say we do an entry here for 10, let's say whatever it might be, 3,000. It doesn't have to be directly tied to any of this. The bad debt expense you're recording each period on sales on account is, again, just a fund that you can pull from to write off things that, and it's only if you regularly have write-offs. Like if you never have write-offs or it doesn't apply to you, then you wouldn't need to worry about this. But if you do need to worry about it. And if you want GAAP compliant financial statements, then you got to have this logic. So that's why we're doing this. All right. So writing off doubtful accounts, 3,000. The entry for that we go to now. It doesn't affect the income statement whatsoever. We go to balance sheet and we say, okay, we want to decrease this because now we're saying, look, there's no more the what we don't have. We're using some of the allowances that we've took as expenses earlier, is what we're saying. So it's a contra asset. I want to reduce a contra asset so it's a positive value. I want to add anything that says write off. What did I say? Writing off doubtful accounts. Let me see how I actually worded it. Writing off doubtful accounts. Okay. Perfect. So let's drag this over and see what it looks like. All right, so here we have doubtful account, and now we're writing it off. So we're actually using some of that expenses that we already accrued. Great, awesome. So the allowance that we can take now drops. Our other entry, so we're not hitting cash flow. We do need another entry here. I'm trying to think what it is. Let me look. Accounts receivable. So now we're actually saying, okay, whatever the sale was made here, whatever this account was that's getting written off, we're not going to collect it. We don't think so. Let's lower the accounts receivable. So then we also have to put write off of doubtful accounts. So this has to be subtracted from the accounts receivable. So we balance. So we'll just put minus that. And just like that, we have bad debt expense, allowance for doubtful accounts, GAAP compliant, all done. Now, what happened in the period of the write-off? So here you can see, look, we lowered our allowance from -75 to -45. Technically, I mean, the number is higher, but we have less that we can now write off. And we took off that accounts receivable. Again, it hasn't hit cash flow. Nothing happened here with cash flow. At all. We haven't actually collected any of the sales. These are just sales on account, so nothing's going on here. Now, when you actually collect the sales on account, you would just, we have an entry here that you can put for receipts on sales of account. Let's say, I don't know, when you do receive those, let's say we received 125. That's not going to affect the income statement at all. It will affect the balance sheet in the form of cash and also reduce in accounts receivable. And then on the cash flow statement, there it is. So that's all fine. That's been coded in and checked, and that works just great. Now, what if, now let's do it, the final wrap up of this. So we know how to enter it. We can track our doubtful accounts reserve. We have write off. Now, what happens if you wrote it off and then you actually recovered it? Well, you have to reverse the write off. So let's see if we can do this with the entries we have. So let's say at the end of the year, or let's say in November, that account we wrote off for $3,000, we collected it. They paid us finally. So that's awesome. You love to get paid. So we got paid the $3,000. How do we account for that? Well, we have to put it back into receivables, but we don't want it to hit revenue. So we actually have to do a separate entry for this because it's new logic. So we have to put recovery of doubtful account. And I'll describe all of these entries and how this all works later. But right now we just need this recovery of doubtful account. So we can put that there for however much it would recover. Let's say the full 3,000. Now, if we recover a doubtful account, it's very tricky. We have to increase the receivable, put it back into the doubtful account bucket because we used it, but now we're not using it. So we essentially reverse this, and then we reverse it back out of receivables. So let's see, actually, technically, we don't need to affect receivables. We raise the doubtful account and we raise cash. Receivables is a net, no effect there on whatever the amount is, so that's fine. So if I put recovery of doubtful account of 3,000, doesn't affect the income statement at all. It doesn't affect the receivables because it just increases it and decreases it. There's no reason to even put it in. However, we do need to add this. We do need to add it to this. And it'll be a plus whatever that value is negative. Because we're saying, okay, this contra asset is actually going to go back up because we've collected the money, so we're no longer using it. So 75. Now wait, where's the entry here? 11/20/23. So we go here, 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 but we write it off in June. So where's the write-off? Here it should be written off. Let me undo, undo. Oh, I need to adjust this. So this is called, now it's going to be called recovery. Recovery of doubtful account. Or accounts, what did I do? Recovery of doubtful account. Perfect. Okay. So here it gets written off, but then what happens in November? We go right back up. And when that happens, that specific transaction, it is going to raise cash. And we can put that under operating activities. Let's see, do we have, I guess it's going to be new. It's with the bad debt, so we'll put it right under there, and we'll just say collection of bad debts. And since that's not hitting income, we need to reconcile it here, and we need to put, what did I say? Collection of, or no, recovery of doubtful account. And okay, we've done our two hardest pieces of logic today. We did deferred tax liability and income taxes and allowance for bad debts. Pretty excited about that. Let's make sure this all works. So $3,000 comes in there. Balance sheet, here we wrote it off, but then we collected it here, so we raised back the allowance. Cash goes up. This is balanced. We are all set. All right, this is so freaking cool, man. This is really cool. I love this. So this worked great. Um, we put the bad debt expense here as an OPEX item. I was thinking about this also with credit cards, but with credit cards, you can use other operating expenses, and you could enter other operating expenses paid on account to create a liability, and then when that's paid, it's just kind of like your credit card fund. You can use that, like it'll be right here. Where is it? Wait, did we do that for that one? Where's other exp not other expenses there? Where did we do other OPEX? General administrative. Okay, so this works. The deferred tax liability stuff all works fine. That's great. Um, So, and essentially with the tax thing, you're just trying to reconcile between what your income tax expense on the income statement is versus what it payable is to the IRS, and then a cumulative difference to that is these two. Now we actually don't need this entry. Deferred tax assets not required. You just put a negative deferred tax liability entry for that. Now what I'm trying to figure out is what are we doing with this other, did I delete it? So if I wanted to put, actually, let's see, I can look at the formula. Other OPEX. Prepaid expense and general administrative expense on account. Okay, so we did that as, I'm gonna have to move that around. So where's prepaid expenses? Oh, I see what I did there. No, so that would not be for credit cards. This all flows to other OpEx. Hold on, let's look at this real quick to make sure this is working right. So that was for prepaid expenses. Let's say you prepay your rent. You do prepaid expense on account. Let's say you pay 15,000 on January 2023. We have an asset here. We have cash going out. And then let's say you recognize 2,000 of that every month, whatever it might be. Okay, and then that actually, I just want to make sure, yeah, okay, so that hits other operating. Now, question, why are we also adding in general administrative expense on account? I think that needs to be removed. This should just, because otherwise it would double count, like um, if you put an amount on account, let's just make sure before I actually remove it. Yeah, it's double counting there. Okay, so that was just an error in the formula. Good thing we caught this. Yes, remove that. Okay, so prepaid expense here, and then it's going down as we pay it. Okay. This is just a payable. Let me get rid of this to stop confusing myself. Cash flow, we're reducing that out into income, adding it back. Okay, reducing prepaid expenses. This is actually add back. And this is where add prepaid expense account. Yeah, that's not for credit cards. That is for prepaid expenses. And yeah, we're balanced all there. Okay. Now for a regular expense, if you're doing cash basis, you would just go general administrative expense, whatever. Let's make it 3,000 for March. That's fine. It's just an expense there. It hits cash and doesn't hit any liability counts. It hits retained earnings. Now, if you had general administrative expense on account, and then you paid that in the following month, and it was a credit card stuff, this is how you would account for that. And then you would put payments of that. Now, if we do that, you see there's the expense hitting in March. Here's the payable. Payable's going away in April when we pay it off. Cash flow, you're adding that back here, reducing it here. Now I'm curious how this balanced when I just had the on account entry. I guess it just zeroed out the cash flow statement. Ah, yes. So when I put on account, okay, that makes sense. And then when you eventually pay it, then it zeroes out there. Okay, so that's how you do a credit card. Um, should I make a note on the income statement? These are prepaid items only. Yeah, I'll keep that note there. That's actually pretty relevant. All right, let's keep going. So we've done taxes, deferred taxes. We've done allowance for bad debts, bad debt expense. Now we need to do sales tax payable, and this is very easy. It actually doesn't hit the income statement at all. It's just a liability and then a payment. So very easy to code in. Let's put an example here. Let's say in whatever month we had sales tax payable increase by whatever the sales tax was for that month. And then you paid it sometime in the future for the amount. So we don't hit the income statement. We do hit the balance sheet. This is a liability. It's a short-term liability. We're going to put this right up here. Sales tax payable. Dang it. Sales tax payable. And then we simply sum up anything that says sales tax payable here. Now, once I'm done with all this, I'm going to extend this out for monthly for 20 years, quarterly, and annual. Um, I'm going to do a test, and I'll do basically when the sheet's done, I'm going to do a test or a version where it's filled out with one entry of every single account so you can see how it works, and also a blank version, and then everything will have descriptions on it as well. All right, so we add that, but we subtract anything, any payment of sales tax. Payment of sales tax. Okay, so there's that. Here, and then there we paid off in April. Again, there is a cash effect. So you can see our check is off by 5,000. That's because on the cash flow statement, well, wait a second. So sales tax payable, oh yeah, when this goes up, we actually increase the cash, so this is going to be an entry down here. We'll put this under bad debts, and we have collection of sales tax, and then also below that we'll do payment of sales tax. Whoop. And that will balance out. So collections when we actually receive the cash, so it does affect cash when we collect that from customers. So that goes up, and then we see a negative when we have to go pay that to the state. So very simple entry there. Okay. So we collected it, we sent it out. Now the balance sheet should balance. Yep, there we collected it, we got the cash. Cash goes down, liability goes down. Income statement is not affected by this at all. All right, let me check my notes. I mean, we got through an hour and a half and I got through a lot of stuff. I'm going for a long time today, so it's not over. I want to do, let me see if there's anything else. Sales tax, bad debt. No, we're good. That's awesome. I'm pumped. I thought that was actually going to take longer. Okay, so let's go. Whoop. Let's extend this out for 20 years and then start testing every account. So what I'm going to do is actually, just so I know, these are all updated calculations. First of all, let's make sure the subtotals are working. Okay, looks good. Okay. All right. I believe these should all be the same. I just want to make sure. So let's drag this over one, and then we can drag these over. All right, so 2023, we can go out to 2042. And it's nice, all the logic's built, so to do this, I just drag them over, and then we'll also add quarterly and annual. And then we'll start doing descriptions for all the categories. 41. End of 42, 10 year, 20 years. Format these, length 15. Okay, balance sheet. Now this is when we definitely have different items in column D. So let's start there. Make sure these are all subtotaling up. I'm excited to test all these too. Okay, let's drag this down and over. Go to 2042. Oh, what's nice about this is you can do a lot in as far as financial statement preparation in Excel, a lot and for a long period of time, and it's not that cumbersome on Excel to do these calculations. I'm essentially using sum ifs for everything. And then for the quarterly and annual, I'll be using probably some index stuff, index and match. Okay, count 241, count 241. Let's do cash flow statement. Make sure these are all subtotaling. Now, what I am excited about is I really want to see people using it, getting feedback. Okay, here's that. Now, let's format this correctly. This and this and this. Okay, so we've extended this out. Now we're going to add in quarterlies. So income statement here, and then we'll do annual. Hopefully this isn't too difficult. I don't think it will be. Normally when I'm doing these, it's like for pro formers, you have to do a lot of stuff to make sure it works with exits and all this other stuff. But for actual accounting system, I'm just going to be looking up the data on the monthly. At the end of each period. And then after this, I'm going to go and define all of the categories and we'll get this thing ready to go. All right, income quarter, annual, balance sheet quarter, annual, and cash flow. So quarterly, how many quarters are in 20 years? 20 years. There's 4 in a year, so 80. What am I doing? So January, February, March, April, May, June, July. Okay. Let's just go until the end. All right, so there we go. We have it. October, November, December. And on this, we'll put, so this will be quarter. Well, we kind of need to do the end of the quarter. Let's think here. We're going to have to do months and years. Oops, C6. Okay, so we got month number, year number. Now on the quarterly, I guess, how do I want to do this? It's really going to be based on the date of what the lookups are going to do. And this is quarter beginning. On this. So quarter 1, 2, 3, 4, 1, 2, 3, 4. I guess that's fine. You could figure out what you want to, how you want to label the quarters. We'll do quarters 1, or I mean years. I guess we could put quarters here too. Okay, so we have here 3, 4, 5, 6, 7, 8, 9, 10, 11, 17, 18, 19, 20. Okay. And then annual, it's just, here's the years. Oh, we only need 20. Now these dates will be formatted a little differently. Whoops, nope, 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 nope. Year, 1, 2, 3, 4. Okay. So these are quarters, year, number, quarter, number. Year number, month number. Now again, the only real relevance is going to be the actual date that I look up. So these other stuff you could delete, or you don't have to have it on here if you don't want. Now this we can copy for all the annual. Oh, 20 years. Okay. Now this should fit. Okay, and then we can remove all of this. Perfect. Uh, let's update the cash flow quarterly. So that's good. Year, quarter, and then annual, same deal. All right. Let's double check this. So annual. Oh, yeah. Okay, so this did. So the income statement we actually messed up here. This needs to go. Oh, it was just this part. So this is the rest of this is fine. Okay, so that's good. Income statement quarterly. I'll zoom out a little bit on all these so we can see. I'm actually going to maximize this. Just so I can really see everything. Okay, perfect. For labels, we're just going to keep this pretty simple. Annual period ending. Annual period. For monthly, we'll do monthly period. On that, as well as the cash flow. Now for balance sheet, put monthly ended or month ended. Quarterly periods, annual, month ended, quarterly periods, annual period ending, monthly. All right. That's done. Now let's do the coding here real quick. Let me get a bite to eat. Hon, can you put this phone on the charger? This phone. What? Put this on the charger. All right. No. What? It's not muted. What? All right. So to do the quarterly for income statement, this is pretty easy. We're just summing ifs, income statement here, if the date is greater than or equal to this. And if it is less than or equal to this, comma 2. Now we lock our 7, lock this. Okay. In theory, this should be pretty much a copy and paste down. Okay, wait a second. Does that make sense? 80 quarters in 20 years? So, oh yeah, 240. 80 quarters would be, wait a second. Am I losing my mind? 80 times 4 is 320 months. And then we've got 20 years. We should have 240. Okay, so what is up here? 20. What is going on? 23, 33. So 2042 is 240 months. 4 quarters in a year. 8, 12. Let's go to 10 years. That'd be the end of 2032. Yeah, something's wrong here. So the end of 2032, we're at, oh wait, no, 40. 10 quarters. 10 quarters. So quarter number 40. Quarter number 80, but it's the 20th quarter. Wait, the 20th year. Wait a second. Oh man. All right. So does that make sense? 40 quarters in 10 years? Yes. So 10 years, 4 quarters in a year, 40. How many months in a quarter? There's 3. So 8 times 3 is 24, 240. Okay. Yeah, sorry about that. That's my math. So this good. Where did I end? Where did I stop at? Here. Okay. All right. Did I get them all? Income statement. Looks good. All right. Now the annual is going to be similar. We do if it's greater than or equal to that and less than or equal to that, comma 11. I believe, let me check it. End of month, C7, comma 11. Should be the last day of the year. Perfect. So here's this. This. Okay. Let's check these. Drag it over. Now, before I move on, let's make sure the income statements quarterly and annual match the monthly. Also, let's give these all different colors. Let's make this balance sheet a little bit different color. And the cash flow. Let's do a light, actually. Okay, so let's do some entries here to make sure it's working. So income statement, we have some different accounts. Let's just put some stuff in here. So let's put sales. Let's put sales on account. Contra revenue. Deferred. Oh, there's actually going to be a ton of stuff. I have to do this so it makes sense. So sales, this is fine. That's fine. Contra revenue. Okay. Uh, deferred revenue, let's say it's 5. And then we recognize it the next month. Cost of goods sold, not inventory. Let's say we also buy some non-inventory items on account and then pay for them. What else? Inventory purchases. inventory purchases on account. Payment for inventory on account. So this reverses this out. None of this actually hits the income statement. What will is the cost of goods sold. So here, let's say we sold some stuff. Here's our cost of goods sold inventory. Okay, now we have some G&A expenses. Sales and marketing. R&D. Let's also say we had some of these on account. Okay, what else? Depreciation expense. Income tax expense. Interest expense. Other income. Other expense. Dividends. That's just cash flow and retained earnings. Now, gain or loss on sale does hit. Prepaid expense. Oh, what else do we have here? Bad debt expense. Okay, let's put some numbers in here. Yep, looks okay. We just want to check if this matches. So we're at 4964. Looks good, 4964. And 4964. Okay, so at least I know I'm summing up everything correctly here. Balance sheet. Yeah, I'm not worried about this. I didn't make exact entries. We'll do that later. All right, so income statement, quarterly, annual, monthly, complete. Balance sheet, not complete. Quarterly, annual, and then cash flow. Now these are easier. Let's do the cash flow, then maybe tomorrow we'll do balance sheet and do descriptions because this probably getting too much here. So this will be easy cash flow for the quarterly. I'm literally just summing up exactly what's in the monthly. Okay, nothing fancy about that. Oh, shoot. Put this down here. Okay, and then annual, same calc, but do 11 instead of 2. All right, let's check this out. So we're at 4886, 4886, and this is 4886. Okay, so that's all just adding up, which is good. Um, Now for the balance sheet, it's a little bit trickier. I believe we do index though. And it's going to be driving me crazy. Why is this up by 2,500 here? Probably because I did something that didn't make sense. I'd have to go through each entry actually, so screw it. We're going to do that tomorrow where I actually do actual entries of everything that can happen, and then we'll test it out and make sure all this is working. And then I'll do description for all these, and then it'll be all done. Which is going to be awesome. Okay, so balance sheet quarterly, I simply want to take the index, and I want to index whatever values in each account at the end of the period. Which is going to be e-date this, comma, to, actually, yeah, 2. Looking up here. So this would be at the end of April. So end of January, end of March, end of June. For this one, we might want quarterly period ending here. Trying to think about this. So for the balance sheet, monthly is fine, and then the annual we could do ending period, but for quarterly it's kind of tricky. And I don't really want to make another space. I guess we could. So here we'll just do same thing, but end of the quarter. So you can see it, that each quarter is comprised of those months. Might as well do it on the income statement as well. Let me make sure this didn't mess anything up. Okay, that's fine. Okay. So this index is taking that comma 2. Good. Okay. Now the variance should be the same, which it looks like it is 2,500. Let's look at the ending period assets 4,964. Okay, it looks good. Again, we'll have more extensive testing tomorrow. I just want to kind of get the formulas in there. So annual is the same deal as the month or quarterly, but we go E-date 11. Oh wait, no. Why isn't this? Move this down one. Let's check what this is doing. Okay, yep, that's correct. Okay, looking good. Trying to get 3 nice colors here on these tabs. Oh, that works. Okay, good. So anyway, here, just take the bottom. Don't forget about our deferred tax liability we did. Oh, actually, deferred tax asset we're not using. We're only using the liability account. Okay, so yeah, we don't need this. All right, good. So we've got all of the formatting. Let's just try to make these look similar. Balance sheet, monthly, income statement. So we got income statement, balance sheet, cash flow, monthly, quarterly, annual. All of its formulas are all done. It should work with all of these entries. Whatever's done, you can do producing financial statements based on anything that happens. This controls the date range of the 20 years. This just is going to control the name of the company on the financial statements. And here's all of our entries that will have logic, that logic ties to. Now, tomorrow, I'm going to define all of these. I wanted to do that today, but I'm just too burnt out, so we're going to do that tomorrow. Also, I will do examples of every single potential transaction that can happen, and we'll make sure that that's populated through all of the financial statements for our checks. Now, we've already tested every single individual type, but we haven't done them all together. And then when I do that all together, I'll leave that there, and the version that is purchased will come with a blank version as well as a version that has all the transactions in it, so you can see. And I feel like I've basically, you know, any small business should not have a problem with this. Now, if you're a large multinational corporation, there's probably accounts here that you're going to have to add, but you kind of get the general structure, and so it's a pretty good starting point at least. But yeah, any small business, which is there's the most of those, they will be able to benefit from this, and even if they're on GAAP accrual or if they're on cash basis, either one you can do here and account for it properly. All right, I'm done for today. This was a solid hour, 9, 10, 2.5 hours. I'm happy with where this is. Maybe hopefully by the end of the week it'll all be done, up and ready to go. And I'll see you guys tomorrow morning